Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, the regulatory landscape, and capital markets. This segment is presented by Charles Schwab. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site, we have Dearborn and Maddie Radner on the Nasdaq Market Intelligence Desk, as well as Kevin Mahn, President and Chief Investment Officer of Hennion and Walsh. We're here to discuss why investors will need to be more selective to find growth opportunities over the remainder of 2025. It is great to have all of you with us, as always. Kevin, I think before we get into where we're going to find growth areas, we have to figure out, are we in this wait and see mode, and why? It is the last week of August,
it is.
So it is a little bit quiet.
Where is vol gone, right? We've basically seen no volatility over the course of the last 20 weeks. In fact, the 67% decline in the VIX is the largest volatility crash on record. That's not normal. Right? Basically, since the tariff tantrum began earlier this year, we saw the market sell off significantly, and then we've seen it come roaring back. In fact, over the first 73 trading days of this year, the S&P 500 was down by over 10%, the fifth worst start on record. But from day 74 to the end of the second quarter, it's up nearly 21%. Yeah. So as an experienced portfolio manager like myself, I start to question, how much longer can this run? When are we going to see more short-term bouts of volatility? And when those bouts of volatility occur again, that's going to create some more investment opportunities. Because I still think there are growth and income opportunities ahead, but you're going to have to be a lot more selective to find them now.
Yeah, and we'll get into that in just a moment. But Chris, perhaps it isn't necessarily that there's a correction coming. It's just portfolio management. And you're at all-time highs. You're taking some gains, making some adjustments, looking for investments elsewhere. And there really is not one single reason why there could be a correction.
You know, the market rally since April, as you said, Kevin, was phenomenal, right? It really turned a horrible start to the year into a pretty good year for just about every investor. Now, when you look at the larger cap names, obviously outperforming, and most sectors are doing very, very well. Some are okay, but some are better than others. And if you're looking to protect right now, you know, you have to start to question yourself, what are you going to do? You're going to be selling certain gains, taking some profits here. What are you going to roll them into? So that's what the other sectors are talking about. We were talking about off camera beforehand. You know, is consumer a good place to start to look, right? The utility trade's kind of played out, and you're seeing that trade starting to unwind. Staples, that trade is starting to unwind as well. Plus, if you look at snacks, those are not a place that people want to be right now, especially with what's going on in that space, to say the least. But tech still is running. You know, and there's got legs, you know, and when you look at that, who's going to be supporting that infrastructure? Energy could be kind of interesting. It's been beaten up significantly. There's a lot of room to run there. And of course, biotech and healthcare have been hit or miss, but much more hit in the last 2 months than miss, especially in the larger names as they start to move along. So what are you going to do? You're going to be very judicious about where you put your money and what you take off the table. Right now, you only got a few more months left in. NVIDIA's the big boy this week with a lot of retail names on top of it. Don't forget, you've got over a dozen major retail names reporting in the next 2.5 days. You know, so Ulta Beauty, Kohl's, A&F is going to be out there. There's a lot of companies, SJM on the Staples side tomorrow morning, that can move these markets. Could be significant opportunities for a lot of people there.
And then Maddie, you start questioning asset classes as well, right?
Yeah. I mean, there's been a lot of fits and starts taking place across different areas of the market outside of large cap tech throughout the whole year, but I think we're starting to see a lot of headlines on the Russell 2000 after a pretty standout Friday. Last Friday, the Russell was up 3.9%. It was the best day since April. We saw the most cash injected into the Russell 2000 ETF really since November on Friday. So we're starting to see some experts really cite some near-term optimism when we think about small caps. Truist upgraded U.S. small cap stocks to neutral from less attractive. We saw Bank of America say Russell 2000 is a likely leader in the coming weeks in absence of major tariff news or macro surprises. I will say in the longer term, a lot of these experts remain neutral. I think they're looking at more short-term outperformance that we've been seeing, but it is something to keep an eye on.
Yeah, we had a strategist on last week with us saying that, you know, when you think about the rotation into small caps, you have to factor in the beta associated with them as well, which is perhaps why you're not seeing that rotation as quickly as one might expect.
Yeah, I think we're going to need to see more than just 50 basis points in rate cuts from the Federal Reserve to get small caps really appealing again. In fact, you may need to get 100 basis points lower and that may not take place, according to the Fed's own dot plot chart, until the end of 2026. However, there are some areas of small caps that we find attractive right now. Biotech is one of those areas, as you alluded to earlier, because we've seen a pickup in M&A activity taking place with certain smaller cap biotechs, because large cap pharma continues to be put under pressure to lower their drug prices. And we also know that they have a lot of large revenue producing drugs that have either come off patent or scheduled to come off patent, and now they're facing generic competition. So where are they going to turn to replace all that lost revenue potential? Well, they're going to have to be acquisitive, and that's where the investment opportunity comes in. Then I think about some small cap names in defense as well. A company like Kratos, the drone manufacturer, the future of military warfare, if you will. Smaller cap name, likely to benefit from all these pledged increases in defense spending. So I like certain areas of small cap, but I'm not neutral or beyond with respect to the entire asset class right now. I would still lean more into large cap. I'd add some international exposures, and I'd also add bonds as a diversifier.
Yeah, and Chris, I mean, we understand with the traditional tech companies that have exposure to
Right.
the AI trade, at some point you're going to Kevin's point, utilities, industrials, energies, that's where the real ROI is going to be recognized. We know NVIDIA, as an example,
Right.
is the AI trade, but what's next when you're analyzing the investments?
We'll let's use retail and consumer as an example.
Right.
Right. So Walmart comes out with earnings last week, and the focus there has been on the trade down effect for lower income. McMillan brings it up on the earnings call as well, talking about the lower incomes having to pivot, doing without or trading off. Right. He's saying the middle income folks, which is a much smaller bracket than it used to be, is starting to impact as well. And he goes, and the higher earners are starting to shop in the store, which is telling you that they're trading down as well. So if you're trading down on certain items like that, and the stock, had an interesting report, it was knocked down a little bit, but it's still, the behemoth that it is. Where is that investment going to come from? And they were uncertain what they're going to do with their AI program on the call. He says we're implementing, but we're still unsure where we're going to be. So there's growth there for that. And if you look at them, Target is a different animal, similar business, but different animal. Management changes, and that got hurt a little bit. And then if you look at other companies that continue to perform well, Costco has already started to implement their AI program into it. So there are people who are starting to make it work, like everybody else, just like Nasdaq here. We're trying to figure it out as well, and where we could put it best to use. And it's going to be a long time before we get that perfected. So there's going to be plenty of opportunity. Keeping your eye on the consumer side, though, you have to watch wages, you have to watch unemployment. We haven't even really talked about continuing claims continuing to go up, right? And you've got inflation data coming out Friday with the PCE. So it's kind of curious to see where that's going to go. The trend lower is definitely on the unemployment side. We've got non-farm next week, so that's going to be kind of interesting as well. A big print there could really spook this market significantly.
Sure.
And with Powell's comments last Friday, boating to the Russell 2000 rally, saying that we are looking to essentially, paraphrasing it, do a quarter basis point cut. That sent the rally into the small caps, but then Monday we saw a pretty big sell-off as well, even though good news is bad news is good news has been the rally lately. So you got to be very careful, like I said before, judicious where you're going to put your money into, but there's definitely opportunities in consumer and retail because they've been a lot of them have beaten up so much that they're going to be, I don't know about a snapback, but once they figure it out, it'll be better.
Yeah, I don't even think it's just associated with the consumer specifically. I mean, think about Home Depot and Lowe's as an example. People are pulling back on bigger purchase ticket items and DIY projects, but they're investing in their pro segments, and that are digital tools. Artificial intelligence capabilities. That's a very different story than it was five and a half years ago when we were talking about consumers doing projects on their homes through COVID and all those outdoor spaces and creating new offices and additional room within their homes. Now it's a digital story.
It is, but you're also seeing home prices start to come down. We get Case-Shiller data today, and FHFA came in a little bit. So you're seeing a little bit of price decline in homes, which is good. If the interest rates do come down, say we do get 50 basis points, that'll be good for the mortgage environment. That'll spur some business as well. And with that, banks could be very an interesting category. There's people who have been sitting on lower mortgages for so long, even though we got a full point last year, really didn't bring down mortgage rates. People who want to vacate their houses if they can find an alternative place to live with a better mortgage. So that's another sector that could be kind of interesting over the next 6 to 12 months as we see where these interest rates go.
Yeah, I just think, Kevin, that we have to rethink our expectations when it comes to the housing market, not even just because of interest rates, but supply and demand as well. We're not, I hope we don't get back down to those levels where you're doing 2.5%, 3% for your interest rates. That suggests something, you know, an economic story. So perhaps expectations just need to be reevaluated.
I think across the board, especially as it relates to the housing market. Remember, the Fed funds target rate is the short end of the yield curve, right? Changes that they make to their balance sheet influence the longer end of the yield curve. And it's generally at the longer end of the yield curve where individual investors borrow in terms of their mortgages. So if the Fed cuts 25 basis points or 50 basis points on the short end of the curve, that's really not having a meaningful impact on the mortgage market such that it's going to turn it around more, and you have all these homeowners who are waiting to sell due to lower interest rates in the future are going to rush to the market to list their houses. So I think you have to level set your expectations there.
Yeah.
But if I look at other opportunities that are out there right now, and I always follow the golden rule in terms of a portfolio manager. I've been doing this 32 years, and I always say to my investment team to follow the money. Where is all the money going right now? Not flows, but spending. And where's the spending going right now? AI infrastructure and aerospace and defense. And that's where I still think there are opportunities. I still think you can find opportunities in the utility sector, like a company like NiSource, one of the largest independent distributors of natural gas in the country. We know how important natural gas is to the AI revolution, right? They operate in states such as Pennsylvania and Virginia. Virginia, which has become the Silicon Valley now of data centers. So that opportunities still exist. And then staying in the industrial sector, you look at cooling solutions for those data centers like a Vertiv or a Modine Manufacturing, a data center construction company like AECOM, or even, let's stay in industrials again, aerospace and defense, a company like Northrop Grumman, which is the manufacturer of the B-2 stealth bomber that actually held that bunker busting bomb that was used in the recent exercise in Iran. So there are opportunities out there, I believe, if you stay within where the money is flowing, where it's being spent, and that's aerospace and defense, that's in AI infrastructure.
Maddie, what can you tell us about the IPO pipeline in terms of where you're seeing flow?
Yeah, I was going to say we're seeing a lot of demand with aerospace and defense companies moving forward with IPO plans. Obviously, the next 2 weeks or week, we're seeing a bit of a slowdown with companies going public pre-Labor Day. But post-Labor Day, as we head into September, there is a ramp up of IPOs that we expect. Going back to some of the sectors that Kevin did mention, I think as we continue to see kind of the U.S. reshoring objective play out, we'll continue to see increased demand for infrastructure, construction, and reshoring related projects. So when we look at some of the small cap sectors, we're seeing materials, industrials, and utilities really take off.
Yeah.
I know I'm focusing on small caps again, but the Russell 2000 materials specific sector is actually up. Index is actually up about 30% so far this year. So even though small cap tech is taking a backseat, we're seeing some of those, you know, opportunity sectors really take off in the space.
Yeah, but it's encouraging to see that it's not just an interest rate story. There's you know, a fundamental underlying need for these types of technologies and infrastructure, and that's, I mean, Chris, I think that's really what your investment thesis should be, not just because rates could move one way or the other, because it could, you know, you take rates down, that could suggest something about the economy.
It could. The question right now is the Fed's been inflation focused for so long. Now they're more focused on labor, right? And that's where we have to see where the data comes from. You know, 2.7, 2.8, 2.9 PPI offsets the kind of okay CPI print. But if you talk about that, brought up the housing before, that flows through to shelter, which has been one of the higher elements of that. So if that continues to decrease, CPI will move in the direction that would be encouraging. But shelter doesn't flow as prominently into PC data. So what you're looking at is food and energy and spend there. I don't know if that trade is really going to work out until we see the data, but then there'll be some tails there if it does. You know, employment's really the key question here. You know, talk about it. Hiring has not been as robust. You know, there's plenty of articles you read out there about people coming out of college right now having a hard time trying to find a job or a position. So the people aren't being laid off. But there's no new creation. So the AI trade is kind of interesting, especially if that starts to eat into some of that employment data down the road. So again, infancy there, but that could be something very, very interesting and a tailwind for a lot of companies.
Anecdotally, in terms of not laying people off, but figuring out where your hiring spend is going to go. Whether it's community colleges or trade schools, I've seen more, whether it's in the traditional mail, email marketing and so forth, where they are looking to reskill, retrain, get into the cybersecurity workforce, get into the manufacturing workforce. These are all high-skilled jobs that pay great salaries, and that is going to be the workforce of the future. So it's not suggesting that they're laying off. They're just figuring out, do we have the right skill set, and where and when are we hiring?
They're preparing for the new global economy that's going to be more AI focused. And I share a lot of the concerns that have been expressed today around the current state of the economy, right? In terms of employment. In June, the Fed raised their forecast for unemployment to end this year at 4.5%. We're only at 4.2% right now. And they think we stay there through the end of next year. And then I think about how important the consumer is to GDP growth in our country. It counts for about 70% of GDP growth normally, right? However, in the second quarter, the consumer's contribution to GDP growth was matched by the contribution of AI CapEx spend in terms of infrastructure building. So is the growth now coming from the consumer, or is the consumer starting to get a little bit more edgy right now and it's being replaced and offset by all these big AI infrastructure spends? I mean, I just saw as I was reading in the green room here, or the beige room over to the left here, that outstanding credit card debt just hit 1.3 trillion in May, the most on records. And delinquencies have now risen 7% year over year. That doesn't sound great.
Well, Matt, you and I talk about all the time, it's not just the overall number that you're getting with consumer sentiment, it's how they're spending and their debt picture, right? I mean, financing BNPL versus putting on your Amex and paying it off at the end of the month, those are two very different types of spending habits.
Yep, I think all the data coming out will continue to be evaluated. How consumers are spending, are they using BNPL? Are they, using more credit, and are they able to pay it off in time? The consumer, as Kevin mentioned, is really the driving force of GDP. So we really need to kind of monitor their spending habits.
Well, Chris, I think this is a good point that Kevin brought up, that there's a difference between the market and the economy. This CapEx spend by the tech companies, that's going to bode well in terms of future growth.
Right.
But that doesn't necessarily mean that it's going to translate into a strong consumer for the economy. They're two very different things.
Right. Like Kevin said before, AI spend is definitely contributing to GDP. I read the same article. It's kind of interesting when you look at it. Are we starting to see a little bit of a shift from consumer spend being so important to tech spend and AI build out? And I think, again, very early.
Yes.
But that could be a big change. When we always say 2/3 of consumer spend is flows through the U.S. GDP. Wouldn't it be interesting by the end of 18 months, another 2 years, 50% consumer spend, right? That means people are pulling back, or we're spending in other sectors. So how does that bode well for certain sectors, right? If you're in consumer discretionary, it does not bode well, right? So there's a lot to think about with the data, but again, we have to trust the data as it comes, and we have to see what happens. Again, we're still in a very unstable environment with the way the tariffs are still playing out. It's hard for companies to predict what their future cash flows will be if they don't know what their input costs are going to be. And you continue to see consumer names, cancel guidance out, even though we had a really good earnings quarter.
And Kevin, in the last minute to wrap up here, there's other implications beyond that as well. If you only get 50% consumer spend, then you start to have, now you start to think about politics and what that means for policy formulation going forward. It's one thing to think that the market's doing well, but if you are not feeling well as a consumer or an employee, they're two very different stories.
Tremendously different stories, and it's starting to take place right now. I don't know how much longer that contribution from CapEx spending on AI infrastructure lasts. I don't think that bodes well for the long-term sustainability of the U.S. economy. It works right now. And I think you kind of have to, as an investor, trade into that. So NVIDIA reports this week, right? I think they're going to knock the cover off the ball again. Estimates are looking for $1.01 per share. I think they exceed that. I think they exceed the revenue estimates. But I'm most interested in seeing, do they have a larger contribution coming from data center than they do from chip sales as they did last quarter? And if, in fact, they knock the cover off the ball again, guess who else benefits? The people who make their chips, Taiwan Semiconductor, the lithographer for Taiwan Semiconductor, ASML. It's not just an NVIDIA story. NVIDIA gets all the attention, but other companies stand to benefit from their success as well.
All right, appreciate everyone's insight as always. Thanks for joining us on Trade Talks, and thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.